Clinton Wilkins, it's spring, and this is a good time to build and to not build, but to renovate.
Renovate, sell your existing home, buy a new home.
Right.
Spring is the best time.
Right. And you set my my last mortgage up.
I did
with Scotiabank.
Yeah, you got some great advice.
That's right. I get some great advice. A variable rate,
Mm-hmm.
and you gave me $20,000 in
A home equity line.
a home equity line of credit, which I am using a portion of that right now because I'm renovating a bathroom.
And at the time, who even knew you needed that HELOC?
That's right. That's right. And it's fantastic because it's already embedded in the mortgage.
Mm-hmm.
The house is paying. It's. I like how neat it is. It's a neat product because it goes on with your mortgage. You pay your variable rate, and it's just so much better than paying out of your pocket, paying cash or paying from another line of credit or out of savings.
Well, and I'm at a much lower rate.
At a much lower rate. So,
typically, right now on a home equity line, the rates range from anywhere from 5.2, 5.4 up to 5.7%. So that's typically where, some are as high as 6.2. So I would say anywhere from 5.2 to 6.2 is where a home equity line would be.
Yeah.
The real big pro is kind of, you hit the nail on the head. It's available equity that's tied to your home in terms of pulling down on a credit facility, but you only pay interest when you use it.
Exactly.
And the nice thing is with these home equity lines of credit, sometimes people will use them for investments. Mm-hmm. Sometimes they'll use them for renovations. And sometimes they'll draw this debt down before using a credit card or before using an unsecured line of credit because the borrowing cost is just so much less.
Yeah.
And when you draw down on your home equity line, it's an interest-only payment.
Right.
But that being said, I don't think they're a forever plan. Whether it's a Manulife One, whether it's a Scotia Step, whether it's a TD Flex line, whether it's a Royal Bank Home Line Plan, it's not forever. Really, if you draw it down and it ends up being long-term debt, what we typically do is we combine what's on the home equity line with the mortgage at renewal.
Yeah, exactly.
And then start again. Yeah. But maybe at that time you have that much more equity in your house and we can increase the credit facility and give people a bigger home equity line of credit. Yeah. I'm doing this every single day.
Yeah.
And HELOCs, I think, were really popular in the 90s. There was a book written, it was called The Smith Maneuver. So it was about borrowing on your home, investments, et cetera, et cetera. But then HELOCs kind of fell out of fashion for a while. Mm-hmm. But now I would say in the last 5 years, HELOCs have become even more popular, primarily because a lot of people have a lot of equity in their home, but they might not need to borrow today, but there is a future borrowing need. And it's a great product. Scotiabank has a great one. We're great partners of Scotiabank, but we deal with a variety of other lenders as well, like Manulife and TD that have a great home equity line of credit product as well. Mm-hmm. And different people's needs are different, and the products are a little bit different between each one of them, but there's pros and cons. Some people can't trust themselves having access to credit. Yeah. And to be honest, Todd, you had a 20,000 was a pretty small one or whatever it was, 25,000. Yeah. But sometimes I'm giving people $400,000 home equity lines of credit. Yeah. And I have to say, are you sure you trust yourself with this? Because technically you could debit right off your house or write a check right off your house or just transfer that right into your bank account. Yeah. So I think that you need to be disciplined. Mm-hmm. And I think some people in HELOCs should not be in HELOCs. Yeah. And I can tell you, I see these clients, I bring them in, I pay them out, and I close them down. Yeah. But responsible people like you, it's great. Yeah.
Yeah, you often said don't use your house as an ATM machine.
Yeah, don't use your house as an ATM. Yeah. There's people that just refinance all the time. And even some of my own clients. Some of my own clients refinance, and then sometimes I think they don't come back because I feel ashamed.
Is that right?
Yeah, I found out about one today that ended up going to another financial institution, which doesn't happen very often. Yeah. Once in a very blue moon.
Clinton lost a client. Breaking news.
I lost a client.
Wow.
And when I found out that I lost them, I was actually a little bit shocked and saddened because I have a long-term relationship with these people. Yeah. And I would look back in their file and I'm like, they refinanced a lot. Mm-hmm. I think it just got to the point where they're like, we feel bad and we don't want to go back. Yeah. I'd rather someone come to me and I give them the advice because I probably would have said, okay, you need to do this, you need to do this, you need to do this. Let's get you on track. So I don't know what kind of advice they got somewhere else, but I always say, come to me. We have an open door. Email me, call me. I'm always willing to talk through a scenario. I never want people to feel, bad about their situation. My job, I always want to put people in the very best possible situation I can.
All right. So outside of if people needing equity or cash or to do upgrades, is outside of a HELOC, what other options are there?
Sometimes people just do a straight refinance.
Straight refinance.
Yeah, and that happens a lot.
At renewal.
Sometimes at renewal, sometimes midterm, Todd. It just depends on people's situation.
Yeah.
And a standalone mortgage is good for a lot of people. The people that would want to do this for improvements, they're doing the work right away. The rate with a mortgage is going to be lower than it is going to be on a home equity line of credit. So if they need the money right away, sure, do it as a standalone mortgage. Then sometimes, even I do the standalone mortgage, I'll still give them the home equity line if they don't need all of the available equity, just so they have a fallback position. But, if they need the money right away, put it with the mortgage because that rate will be less.
What percent of people who are qualifying for mortgages pay their mortgage and don't default? It's an astronomically high number.
Like 99%.
Yeah, 99%, right.
And I'm just throwing 99 as like a number, but it might be actually above 99.
Is that right?
Yeah, it's a very high percentage.
Yeah.
And the Canadian Bankers Association thought that we would see more defaults up to about a 4% range.
Yeah.
We've not seen that. I think there are more arrears today than there were over COVID because there were so many programs. And that's one thing that we need to be very cognizant of going into tariff situation, us seeing our economy go into recession. There can be more losses and more defaults. Ask for help before you get into a default situation.
So what's the role for CMHC or Sagen? Is that the other?
Canadian Mortgage Housing Corporation, Sagen, and Canada Guarantee.
What is their role? I mean, we pay a lot of money for these.
Yeah, so anybody that buys a home and they put down less than 20%, they need to have insurance from the Canadian Mortgage Housing Corporation, Sagen, or Canada Guarantee. All three essentially do the same thing. And depending on the percentage you put down, you pay a premium to the insurance company, which is this body. But then that grants you access to getting a high ratio insured mortgage. And really the insurance is against the homeowner. It's basically insurance to protect the bank from you, the borrower.
Right.
The reason being is there's not that much equity left in the property. So if the bank had to take the property back from you, the insurance company would cover the bank for any losses.
I see.
But these insurance companies have a lot of really good programs in place as well that basically will help homeowners stay in their home if they're having financial hardship. So if they actually try to work with someone, they can keep them in the home even if they're having some financial challenges.
Yeah. So so if you want to avoid the CMHC or these,
you need to put down 20%.
How much money are we talking? Does it cost
for the CMHC premium? Yeah. So, for example, if you buy a standard house in Halifax, let's say the standard house is $500,000, and you put down 5%, which is the minimum down payment. The high ratio insurance premium, based on a 25-year amortization or less, is 4% of the mortgage amount.
Wow.
So 4% on $475,000, Todd, is a good chunk of change. That's $23,750.
Wow.
And if you're a first-time home buyer, or if you're buying a newly constructed property, you can go up to a 30-year amortization, and that insurance premium is 4.2%. So it would be almost $20,000, $19,950 if you did a 30-year amortization.
Wow.
So essentially, you've almost financed 100% of the house with the insurance premium in there.
Yeah. So the optimal situation would be to have 20%.
That is the optimal.
Yeah.
Now, there are a couple other upsides from having a CMHC insured mortgage, though.
Okay.
Typically, the rates are less.
Yeah.
And that kind of surprises people sometimes. They're like, well, if I'm putting down 20%, I should get a lower rate than if I'm putting down 5%. No, because 5% is a lot less risky because we have the insurance from CMHC, Sagen, or Canada Guarantee from the bank, and they're able to then offer you lower rates. Those mortgages can also be packaged and sold off in the Canadian mortgage bond. So the cost of funds is a lot less.
Right.
For a CMHC insured mortgage.
So it would be a numbers game then. I guess you would have to look at if you're paying 20%.
It's always cheaper to put down 20% and pay a higher interest rate.
Right. So
always.
That's going to, but that said, it's not a complete loss because of the things you mentioned.
Yeah, you can get a lower interest rate and there are some additional protections. There's a couple other fun things that the insurers do. They have a green home program. So if you buy a home and it has an Enercan rating above a certain number, or if you go and get an energy efficiency test and it comes back, depending on what score it gets, you can get a percentage, typically up to 25% of your CMHC premium back. And that goes right to you, the borrower, not to the bank.
Yeah. What about solar panels and those types of energy upgrades?
Yeah, I think
that's a good time if you're refinancing or whatever it
like
might be?
to make your house more efficient.
Yeah,
I think
sure.
making your house more efficient is always a great idea.
Yeah, there's rebates and all types of things that you can get.
And the province has different things on the go, so I think that's certainly something to look into. I don't know if solar panels really hit, to be honest, Todd.
Yeah.
Like I see some people, there's some houses that we see that have solar panels, but not en masse. The one thing that I see that people are adding is heat pumps. I see a lot of people taking out their oil furnaces and putting in an electric furnace with a heat pump. So that's with central air. And I'm seeing, a big popularity with even mini splits for people that have, electric baseboard, or they have a different heating system that maybe central air doesn't work. So we're seeing a lot of mini splits as well.
So the financing of those, can that be done through when you renew the mortgage?
Yeah, why not? You can always refinance up to 80% of the market value of your house. So let's say, again, the house is worth $500,000. We can do a new mortgage and or HELOC combo up to $400,000. So that would be 80% of the market value. So if the house is $500,000, we can go up to $400,000.
Wow. And how many people generally do that? Have you seen a lot of uptick in that?
I would say in refinance transactions, the bulk of our clients will go up to 80%.
Yeah.
The bulk. I'm not saying all. Obviously, different people have different needs, and sometimes they can't qualify for the full 80%.
Yeah.
It really depends on their income. It depends maybe the location of the property. Like I have a client that I was working with down towards the valley. The credit wasn't so hot and the location was more rural. The bank said, yeah, we'll do this transaction, but we're only going to do it to 65%.
I see. Yeah.
Which, again, pros and cons.
Yeah.
Would you rather an approval or no approval at all?
Yeah, that's right. And rural areas as well have downsides because you're not on city municipal water.
Exactly.
And
I would say well and septic certainly is more risky.
Yeah.
And also the days to sell your home if you become into financial hardship takes longer typically in a more rural area. That's just reality.
Yeah. So those homes would be harder to finance then?
Sometimes they can be, especially for more risky borrowers. When we talk about things like alternative lending or B lending, some of the alternative lenders don't want to go to some of these more rural areas because of concerns on foreclosure. So if they have to foreclose, can they actually sell the property, or are they going to have to take a big loss, and how long is that going to take?
Yeah, for sure. Yeah, but this all circles back to why a mortgage professional, a mortgage broker like yourself, and having reviews are important.
It's so important. And we do an annual review with our clients.
Yeah.
And that's the one thing that I think sets us apart from retail banking. As you know, Todd, retail banking, people are changing over all the time. Yeah. The turnover is wild. For me, I've been doing this for 20 years and I have a lot of clients, but we reach out to them every single year to touch base and say, do you want to renew? Do you want to review your finances? Are you in the best financial position? Do we have you in the best product? Things change with people. Yeah. Think about even yourself.
Yeah.
Divorce, marriage, health issues, moving, changing provinces, changing jobs, becoming self-employed. Now being employed. A lot of changes.
Yeah.
A lot of changes. And that's why it's so important for people to review their finances. If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.